This is the Alhambra Investments Weekly Market Pulse with Joe Calhoun. And Joe, in your report this week, had some interesting facts I want to start with today. You said that from January 4th to May 20th, the S&P 500 was down almost 21%. And then in the next 6 trading days, it went up a little over 10%. So it brings me to the title of your article this week, Is the Bear Market Over?
Well, we've set a low. Whether it is the low or not is something we don't know yet. I would say that it is typical of bear markets to have rallies like this that are very rapid. But that doesn't mean anything. I mean, there's an old saying on Wall Street that tops are a process and bottoms are an event. And in my career, that has certainly been true, where we see, I think in my career, there's been several times where I knew on the very day, I knew for a fact that was the low. You could just feel it. It's one of those things that it comes with experience and so forth. I didn't really get that feeling with this low. I suspect we're going to be back down there, but I don't know. I think that the sentiment didn't quite get negative enough, I guess is a good way to put it. But there are some interesting things on the positive side of the ledger too. We'll talk about some of those things, I suppose. But is the bear market over? Yeah, my short answer is probably not. But as you can tell, I've got a lot of conviction with that. I don't think so, but we'll see.
Well, for investors who have a standard 60 stock, 40 bond portfolio, let's look at some numbers here. Even after that 6-day rally, they're still down about 11.5%. Here at Alhambra, our accounts, moderate accounts, are down 4 to 5%. So what's the difference there?
Well, first of all, let me just say the 60/40 that we track is Vanguard's all stock and all bond. That's what it's composed of, total stock and total bond. So it is and that's US. So it's a US based 60/40 portfolio. I think it's pretty standard stuff. I mean, look, other people might use the S&P 500 and the Lehman aggregate or something like that, but I think that's probably a better way to go. Is just kind of that total market type approach. It's a decent benchmark for us for our moderate accounts. Our moderate accounts have 30% bonds, first of all. So we didn't take as big a hit on the bond side as the 60/40 portfolio. By the way, our 30% bond portfolio is our moderate choice because it has actually a lower standard deviation. If you look at the long-term track record, there's a lower standard deviation than the standard 60/40 stock bond portfolio. Actually, to match the same standard deviation as the 60/40, we can do with our portfolio with as little as 20% bonds. But you get a little bit more a little bit bigger drawdowns and so forth with that type of portfolio. So we don't generally recommend that. For us, moderate is 30 to 40% bonds. And I say 30 to 40 because it might be that someone who's 55, it might be 40% bonds, whereas somebody that's 35, it might be 30% bonds. Anyway, the difference is the non-correlated assets. We own commodities in our portfolios, which have done very well this year. We do have gold as well, which is up, and it's not up much, but it's, if it's a positive number, it's a heck of a lot better than stocks or bonds. We do own real estate too, which has been hurt this year, down just about as much as stocks are, just really. So, I mean, that's, we have the same bad parts of the portfolio, I suppose, or some bad parts of the portfolio. On the stock side, we also made some pretty good choices, I think, last year. I wrote a piece last year. I basically, in November, I said, look, the S&P 500 is essentially uninvestable here. The multiples are too high. The concentration in those big growth stocks was too great. It was just at some extremes that really, begged you not to buy the thing. And so we don't own the S&P 500. We haven't owned it since actually, we started selling it before we got to that point in November when I wrote that article. Oftentimes we do things internally before we tell the public about them. One of the reasons we get paid. Anyway, we did sell the S&P 500 last year. We didn't own any of the growth stock indexes. So we came into this year with value and dividend-oriented portfolios. Those have done quite well. Dividend portfolios are up this year. Value is down a little bit. We also have international value, which is down, I think, a fraction of a percent of the year. So those things definitely helped us on the equity side. But mostly it's about the strategic allocation, the big long-term plan, which includes those non-correlated assets.
One of the things that the comments we get about what we do every week right here, people say it's really helpful for me to hear what you guys are doing in your portfolios. So let's look at 2 of the things that you wrote about in the article this week. If the bear market is not over, how are we going to invest going forward at Alhambra?
Well, Yeah, I mean, look, if the bear market's not over, we have to decide. I mean, first of all, we need to figure out why it's not over. Look, that's not an easy thing to do. In general, bear markets are associated with recessions, but not always. We have had bear markets in history that didn't involve recessions. We've also had what I call near bear markets, minus 19.5%, minus 19.8. I mean, if you want to call 20% the bear market, that's fine. But I got to tell you, if you can tell the difference between 19.5 and 20, yeah, I think you're slicing and dicing it a little too thin there. But we have had plenty of those instances where we've had big drawdowns in the market, in the stock market, without a recession. I would also say, too, you go back and look at 2000 to 2003, we had a situation where we had a big drawdown in the market before the recession started. The recession was very short and shallow, and the bear market didn't end until way after the recession was done. So just looking for recession is part of the puzzle, but it's not the complete puzzle. A lot of times, especially like that 2000 to 2003 bear market, was really more about valuations and how high they were, which is very similar to this episode as well. So what we're looking for now is if the bear market's not over, we have to make a decision. We're either going to stay with what we have, which is already defensive. You know, we have a bond allocation that is it's kind of a barbell. We've got some in the short end, the vast majority is in the intermediate stuff, and we got a little bit in the long end. That's fine. If we go to recession, we might want that to be a little bit more in the long end, but it's really not that big a deal. It's pretty good where it is. We also hold 15% cash, and we hold these defensive equity positions. We're underweight every asset class except for bonds. So, I mean, we're already in a position that's defensive. So if we think we're going to recession soon, then we have to make a choice. Are we going to get more defensive? Now, this is a big, big step for us. This does not happen very often. And it really, you have to get the timing very, very right on this. So you can miss big moves in the market. So what we would be looking at is making what we would call a tactical change to our strategic allocation. And that's some military term words there. I know what they mean. I'm not sure everybody else does. A strategic allocation essentially doesn't change. A strategic allocation is your long-term plan. If you're a moderate risk investor and you got 30% in bonds in your strategic allocation, you're not going to vary from 30% bonds by much or very often. Now, if we think we're going to recession, we could make the choice to make a tactical change to that strategic allocation and go from 30% bonds to 40% bonds. But that takes a big, big high hurdle for us to do it. For us to do that, we got to think that recession is imminent and inevitable, that we're not making a false step here. So there are some things that we watch that are, have a great track record, a long-term track record of very few false positives. So we know that the CFNAI, the Chicago Fed National Activity Index, has turned negative. The 3-month average has turned negative before every recession back to the 60s, with one exception, 1973-74. We know that leading economic indicators, the Conference Board's leading economic indicators, always turn negative year over year prior to recession. And the only exception was 2020 with COVID, which came on very, very rapidly. And even there, it was at zero. We're at about an 8% year over year change right now. And there are other things that we watch too, credit spreads and so forth. But credit spreads have quite a few false negatives or false positives. Where we're looking for above average yields there, above average spread between junk bonds and treasuries. Right now, we're still below average, so that's not a warning sign yet. The point is that if we got to get some very, very solid evidence that recession is on the way and that we're going to have it, and if we do, then we would make that final step to get more conservative. So that's kind of what we're looking for on if the bear market is not over.
All right, the other side of the equation. What if the bear market is over? What do we do then?
Well, if the bear market is over, we got to put that cash to work. We've got 15% cash. We've got a fairly, our bond portfolio is fairly neutral. So, I mean, our default in bonds is to intermediate. So we've got some on the short, some on the longs, and the vast majority in the middle. You kind of average them out. We really are an intermediate portfolio right now. So we don't really do anything in bonds, but the rest of the portfolio needs to get fully invested. And we also have to make a choice about how to do that. What is the tactical choice of how to invest that money? Right now, we have dividend-oriented portfolios. Select dividend, if we're talking about an all ETF portfolio, we're using DVY or SDY, which are two dividend-oriented ETFs, one by iShares, one by Spiders. So those, they're similar, but not exactly the same. And we kind of mix and match. We use some somewhere and some in some accounts, some in others. But the bottom line is we've got that. That's a very defensive portfolio. DVY in particular has a big allocation to utilities. We also have these value indexes. We have the S&P 500 value and we have EFA value, which is an international value index. Value is cheaper than growth, no doubt about it. It's quite a bit cheaper. I wouldn't say it's outright cheap. It certainly has been cheaper in the past, but it is a lot cheaper than growth. The EFA value index is really, really cheap. It's less than 10 times earnings. I don't think we would change that. But in the US, we'd have to make a choice about that dividend portfolio. Do we want to take some out of that dividend portfolio and something that's more growth oriented? I'm not sure that's the right answer. I suspect that value is going to continue to outperform. I think we are potentially moving, having a big shift here in people's perception of investing. I think people want things that are more real, less, I don't know how to put it, less ephemeral, less, less kind of just an intellectual idea like crypto, which, has no physical value. In fact, I would say no value at all, but that's a whole different story. I think people want to see more real investments, and I think part of that is value. So I don't know. The dividend piece may get reduced. You may do something there that adds more direct investment in, like I said, a little bit more growth-oriented stuff, a little bit less defensive. But the bottom line is you got to invest that cash. And it's not easy to do when markets are moving rapidly, like a 10% move in 6 days. That's the beauty of markets, though. Listen, I don't think this thing is going to go straight up. Most markets don't. And in fact, if it goes straight up, I would tell you that, maybe that's not a good sign. Here's what I mean by that. We saw something similar to this in the 2002 bear market, where we had an initial sell-off, I think about 14% in the S&P and mid-30s in the NASDAQ. And that was from March 2000 into, and it went very quickly, April and May. S&P bottomed in April, NASDAQ in May. And then you rallied into the end of the year, and you rallied almost back to the highs. The S&P got within about a 1.5% of the all-time high. NASDAQ didn't get as close, but it was about 13% from the high. And it went very rapidly. It was basically straight up. It would worry me if this market did something similar to that, because what happened after that was not pretty. S&P ultimately was down, 40-something%, and NASDAQ, as just got killed. And it took, from that beginning of 2001. And by the way, the recession in that case, even though the market peaked in March of 2000, the recession didn't start till March of 2001. The market was already declining way before the recession hit. And that may be similar to this time. It's possible. I don't know yet. But it would bother me a lot if the market rallied straight back to those highs too fast. So if the market pulls back, it gives us time to make some choices about how to invest this cash that we have on hand. Look, we're getting a little bit of a pullback today. I mean, we were down, 300 or 400 points when we came on here. Maybe that's going to be a little bit of a correction of last week's, move. I don't know. But the bottom line is, don't be in a rush here. If this market's going to take off and go straight up, you don't need to be buying it. If it takes its time and there's some back and forth, then I think you can maybe be more constructive about it. So let's see what it does.
All of that said, you're not convinced that the bear market's over yet.
Yeah, I don't know. I want to see, I want to see some really extremes on some of the sentiment stuff. I want to see put call ratios on the indexes get over 2. Haven't done that. I want to see the total put call ratio get up to about 1.5. Hasn't happened. I want to see equity only at least get over 1 and hopefully 1.2. And the high was like 0.88. Not there yet. Look, there are some positive things though, and I mentioned that earlier. Look, insiders right now are buying a lot of stock. The insider buy sell ratio is almost to 1 for 1. And, insiders obviously are mostly all the time selling. The long-term average there going back to about 2015 is about 0.47. So, twice as many sellers as buyers. Right now, buyers and sellers are pretty well evenly balanced as insiders. That's actually a very bullish sign. Last time we were here was in March of 2020, and we think we know what happened after that. So I think there are some positives out there, but I would like to see some more extremes in some of the sentiment measures. We've seen extremes in the sentiment measures that are survey based. We haven't really seen them in market-based things. I want to see people acting bearish rather than just talking bearish. And I don't think we're quite there yet.